In today's video, we're talking about Roth conversion mistakes. Roth conversions are an important part of retirement planning, and you don't want to make these mistakes. We're going to go over it next. Hey, my name is Mel Stubbs. I'm a financial planner with Christy Capital Management, where we're trying to help federal employees retire better, to be more knowledgeable so that you can have confidence in what you got going on. If you need help, click right up here to talk to an advisor. The first mistake I want to go over is not taking advantage of the full tax bracket. Or said another way, leaving unused portions of the tax bracket open. The way Roth conversions work is that you take a portion of your traditional money and you're moving it over to Roth. You can do as much as you want to do. The only limit is the amount of taxes that you want to pay. So you could move $600,000 over to Roth all in 1 year if you wanted to. But it may not be wise as it moves you all the way up into the top tax bracket. The mistake I see is people not doing tax bracket planning. In a perfect world, what you would do is figure out your income, what's it going to be, and then map yourself on the tax bracket and figure out how much room do you have left in that bracket. How much more room do you have in the next bracket? A good practice is to figure out what tax bracket you're comfortable paying taxes on. Generally speaking, as we're talking to people seem to be okay paying taxes at the 22% tax bracket level. If you're married filing jointly, the 22% bracket goes up to $190,750. If that's the highest point you're comfortable with, then doing proper planning would be figuring out what is my normal income going to be? How much room do I have up into that $190,750? And then you'd want to Roth convert that amount. If you Roth convert less than that, then you're leaving an unused portion of the tax bracket that will be forever lost. Next year, when you want to Roth convert, you'll still have to play by the same tax bracket rules. So wise planning would be taking advantage of the full tax bracket. Some people are okay with going up into the 24% bracket, which would be an income of $364,200. If that's you, that should give you a lot more room to Roth convert more money. Why would you want to do more money? Well, in 2026, the Trump tax cuts are supposed to sunset and go back to the old tax rates. That means that the 22% rate that we just talked about is going to go back to 25%. The 24% tax bracket is supposed to go back to 28%. That means you have a couple more years to take advantage of the lower rates. If that's the thought process, you may want to Roth convert as much as you can, and so take advantage of the full tax bracket. Don't leave unused portions of the tax bracket if you're trying to maximize the amount that you can do. The second mistake is not factoring in distributions that you need to make throughout the year. Let's say at the beginning of the year that you do the tax bracket game we talked about, and so you figure out your income and you figure out, I'm going to max out the bracket and I determine I'm going to do a Roth conversion of $75,000, and you go ahead and you do it early in the year. But then around summer, you realize that you want to buy a new car, and you're going to take a distribution from your traditional account to buy the car. And then you realize, I've already maxed out the tax bracket doing the Roth conversion. So when I take this distribution, that's going to push me over the tax bracket. So think about potential distributions that you may need in that year and try to figure that out and work it into your Roth conversion plan. If this is a concern is a high priority to you, then it may make sense to do the Roth conversions later in the year. There are different times of the year that make sense to do Roth conversions. The benefit of doing a Roth conversion at the end of the year is that by the end of the year, you know what your distributions are, so you can factor that into your number because you've already taken them. The third mistake is not factoring in Medicare premiums. When you get to be age 65 and over, Medicare premiums are based on your income 2 years prior. So if you're 65 in 2023, Medicare looks at your yearly income in 2021. Married filing jointly, $194,000 or less gets you the standard Medicare premium. If your income goes up to $246,000, you have the first step up of an increase. Above $246,000 up to $306,000, you get the next step up. So as you're Roth converting, in a way you're artificially making your income higher than it would have normally been. So if you're 63 and over, at least think about Medicare premiums. That doesn't mean stop all Roth conversions because I don't want my Medicare premium to go up $67. Lots of time, Roth conversions can be more valuable than paying $67 more a month on your Medicare. But you just want to know about it and be aware of it. The fourth mistake is if you're charitably minded. The mistake would be not keeping enough traditional money back to be charitable with. When you reach the age 70 and a half, you can do what's called a qualified charitable distribution. This is where you can send money directly from your IRA to a church or charity, that's of your choice, and you don't pay taxes on it. If you Roth convert everything so that you don't have any traditional money, and then you want to be charitable, you're going to have to give away from your checking account and hope that you get the charitable tax deduction on your tax return. The standard deduction has gotten so high, in 2023, it's going to be $27,700 if you're married filing jointly. Now, for a lot of people, being charitably minded, they're not getting the tax deduction because it's not over $27,700. Doing a qualified charitable distribution gives you the tax write-off even if you're using the standard deduction. But you can only do it if you still have some traditional money. So as you get a Roth conversion plan together and you're aiming to convert a lot, I'm just mentioning that you may want to keep some of the traditional back so that you can be charitable with it later in life if you want to. If being charitable with it is not important to you, then feel free to Roth convert everything and don't worry about this last mistake. Lots of people I talk to are already being charitable with their money and they don't know about this rule. We have lots of people already giving money to their church on a monthly basis, where once you hit 70 and a half, we explain to them how you could stop giving monthly from your checking account and let us do a once a year distribution from your IRA, traditional IRA, to save you some tax money. So these are the 4 mistakes with Roth conversions. In my opinion, Roth is an important piece of your retirement planning. If you're worried that maybe it's too late for you, then watch this video right here. Is it too late to start Roth TSP? If you're still working for the federal government, is it too late to start now? Watch this video. My name is Mel Stubbs. I'll see you next time.